right, so welcome back, and what we will be doing today is we'll be doing journal entries. From this point on, you'll be doing journal entries, and of course, after we finish this chapter, this is what you're going to do a lot of. Chapter 5 is going to talk about the income statement. That's a little bit more in depth than what we did the other day, but we're going to actually go into journal entries. But to really understand journal entries, we have to continue to set up our foundation. So we're going to go through that again as we normally do. Always looking for the choir, right? Make sure you're with the choir. I promise you, we settled a situation the other day by actually doing this type of thing. So let's start. We're going to start with the balance sheet. What is the balance sheet? The balance sheet is going to be an equation. What is the balance sheet? What are the components of the balance sheet? Assets. What else? Oh, give me some choir now. Assets, liabilities. See, I can get going when y'all go. Liability and stockholders' equity. All right. So we have those three. And what's the relationship? Something, something, something. What's the relationship here? Assets equals liabilities plus. And let's don't lose sight of why we're doing this now. You buy something. Either you're going to have 100% ownership in equity in it, which means that it is yours, or you're going to purchase it a little bit on credit, and you're going to, own a little bit as you go. That relationship is going to change to 100% ownership. So that's why we're doing it, okay? Now, under each one, we have some things that are very important. We have different types of assets, different types of liabilities, and different types of equity. What are our two different types of assets that we have? Current, that's correct, and long-term. What about when we get over here to our liabilities, what do we have? Same categories, all right? Current and long-term. Now, we have two different types of equity, but let's remember what equity is first. Equity is ownership. Equity is purely ownership. Now, that ownership is going to form two different ways. What is the first category? And I say first, not in terms of which one must go first, but which one would you like to give me first? Retained earnings, okay? Retained earnings, as we know from last time, is just information, it's income that we had left over and kept or retained in the business. So we will have some income, some retained earnings here. And the other one we'll have is some what? Common stock, okay? And later on, that's abbreviation, common stock. We'll have this thing called preferred stock. Don't worry about it. Like I say, I can't tell you where to go buy it from because I don't have that type of money, so it must be some valuable stuff. If you ever buy some preferred stock, believe me, you will be happy you did, okay? Now, the reason that we have this here is because when we have current liabilities like utilities or something like that, we need to be able to pay our utilities out of what we have that we can turn to cash quickly, right? Now, what do we call the term turning something to cash quickly? What do we call that? Liquidity. And so we must always list our current assets in order of what? Liquidity. What is our acronym that we use to help us remember that? CRISP. They must be CRISP. That's correct. C-R-I-S-P with the what? With the D. And where's the D go? Between the C and the R, okay? Just keep that in mind. Now, let's go through them. The first one is what? Cash. Next, receivables. Next, inventory, supplies, prepaid, and what else? Debt investments. That goes right here. It's just a little bit easier to remember it. Just remember where to put the D from. Otherwise, we would have it out of order, okay? Everybody good so far?
The D is what again?
The D is for your debt investments. Debt investments. And it always goes cash, debt investments, receivables, inventory, supplies, prepaid. But just to help us remember, that is the debt investments. All right? Any good question? Any more questions? All right. And of course, our long term, we have things like patents, equipment. That's one of the biggest things we have. Property, plant, equipment, land, all these type of things are what we have there. Okay? Everybody still good? And of course, we have our current assets. We talked about current liabilities. We have to have enough of these to pay these. If I have a light bill due, and I have the best building that you know, can I pay for that light bill out of this best building that you know? No, because I have to go sell that building. I have to first of all find a buyer, and that's a lot of money to get just to pay this. So this is why we must have our current assets and current liabilities. Everybody still feel good? All right. Now, let's go to the other part. We have 4 financial statements. 3 of them we'll cover in here. The first one is called out what type of statement? Income statement. What's the next one? Retained earnings. What's the next one? Balance sheet. And then we're not going to worry about the statement of cash flows in here. Now, when you get to managerial accounting, yes, you would do that, but that's a totally different subject. We're talking about the income statement. Our income statement consists of what? Expenses and revenues, right? And once you have your revenues minus expenses, hopefully you have something left over, which is going to be your income, and your income is going to eventually go into your what? Retained earnings. Let's see what this looks like. I'm going to draw a line here because I'm not trying to do anything with these, but I just want to see what's going on here. Our income consists of our revenues, right? Minus what? Expenses gives us our what? Income, as we said. This is just an income statement. This flows into our retained earnings. Now I'm going to actually connect these. Where are my retained earnings located? Under the equity, right? So when I finish all of this, this is going to go, I'm going to leave a circle right here. This is going to go to retained earnings. But what must I do first? I must calculate how much I have for retained earnings, right? So retained earnings starts with what? Our beginning retained earnings. Then we're hoping to add some income. If we have a loss, will we add it or subtract it? We'll subtract it, right? Just think about it. Retained earnings is an accumulation of all the income that you did not spend. So if I have a loss, then I have to do what? Subtract it, reduce it just a little bit, okay? Hopefully just a little bit, hopefully not too many times, okay? But that's what I'm going to have to do. Now, out of my retained earnings, I'm going to make some payments to my stockholders, to the people that own it. It's my company, but it's your company too, right? And you're not just giving me the money because you're nice. I mean, you will, but you're not just nice. You want something in return. So hopefully we would like to see our stock, as we call it, or our investment grow. But in the meantime, we can get some starts with a D. Some dividends. I pay my dividends out of what? The income or the retained earnings? Retained earnings. I know that retained earnings is going to accumulate, but it's always paid out of income. So I'll basically have my beginning retained earnings, plus, or as our books say, add income, and it says subtract or less dividends. That's going to be my ending retained earnings, which is going to be in here. Okay? Is everybody okay with that? And so that's why I made this circle, because I want us to know that yes, it comes over here and gets here, but we have to do a little bit of work to get it in there. Oh, yes, ma'am.
So what are those in the circle?
That's your beginning retained earnings. That's what you have at first. We can have 2 scenarios now. If you just started a company this year, January the 1st, had you sold anything as of January the 1st? Had you done anything in January the 1st? You don't have anything that happened before, right? So your retained earnings with a brand new company would be 0. Anytime after that, your retained earnings is probably going to have a balance, which we hope is going to be a positive balance. Okay, that's just something to keep in mind as we go through our financial statements, somewhat in the journal entries, but definitely as we go through our financial statements. Help you out? Okay, I just gave you one, I'm sorry. Beginning retained earnings, add the income. Add income. If it is a loss, then we're going to subtract that income. And that makes sense, right? If we had everything, we're continually filling it up. But if we lose a little bit, we have to take it out. We have to show for that, okay? Now, we're going to pay dividends to the stockholders. We're going to pay dividends to the stockholders. Is that going to cause my retained earnings to increase by paying out? Or is it going, that's right, it's going to cause it to go down, okay? So less dividends, and then we have our ending retained earnings balance, which goes right here. Or to say it differently, we're going to update this based on what we have here, okay? Was that helpful there? All right, the last thing we have is just to see that we have assets, right? But how do we know if they're going up or down? We have to use some type of system to know if they're going up or down, right? That system is called a system of debits and credits. What does debit mean? Does it mean left, right, up, or down? Say again? It simply means left. That's correct. It simply means left. It only depends on the character of what you have. We talk about playing a note. We had the Super Bowl yesterday, so in the note, there are a lot of different notes out there, right? You can take any note out of any of those songs and play it. It will mean nothing to you unless you put it in the context of a song. So an asset, a liability, or an equity is what's going to determine if it means positive, if it means increasing or not. Usually this goes below, but for the sake of space, we're going to put this above. We are going to show an increase in my assets. If I buy a car, I'm increasing my assets, right? How do I show the increase? With a debit or with a credit? A debit. Good. I'm just going to put a plus here. That's any asset that goes up now. We talked about earlier, we might have some equipment. I'm going to show that increase in equipment with a debit. If I sell that equipment, then I'm going to do what? Take it away by what? By a credit. That's right. If I buy some supplies is a what? An asset. And I'm simply going to show that increase in the asset by a what? A debit or credit? By a debit, that's right. And I'm going to show an increase in inventory. We got to sell stuff, right? So I'm going to show my increase in inventory with the what? With the debit, okay? Any questions on that? Any questions? All right, everybody good? What about my liabilities? Think of it like this now. Anything on this side of equals, if it goes up right here, then we have to have a balance, either something happening right here or something happening over here. I'm going to show an increase in liabilities. I created more debt for myself. If I showed an increase of the asset with the debit, then how am I going to show the increase in my debt? With a credit. Now, when I look at it, my debit and my credit are equal, okay? Basically, this is going to be how we check our work to a certain degree. At the very least, we want to make sure that we have the same numbers. Now, whether you chose the right account, that's small, you know, but if we have the same numbers, that's just adding, that means we add everything correctly, okay? And for our equities, it's on the same side, we're going to show an increase with the what? Debit or credit? Credit. Say again? Credit, that's right. All right? Everybody good? Everybody good? This is funny. Like literally, almost all the guys over here, my tenors and bass, almost all my sopranos and altos over here. That's amazing. Like it wasn't done on purpose. I know it wasn't done on purpose, but that's funny. So, all right. So let's get ready. Let's keep going. Everybody good with that? Because what we're going to see is we've already started chapter 3. All right. Let's get some of this out of the way. I'm going to leave that up there. It's always nice to have. I would literally write that on my exam. I know you can do it because we just did it, and we've done it not just for the first time. So I know it can be done as we go. We're going to have a slight modification to that, but write that on your exam again, because at this point in time, all we're going to do is add accounts. Now, to journalize, when we think about journalizing, we're doing things to help make sure that we keep up with stuff. Everything we do journal entry-wise is going to eventually end up in here. Even though revenues and expenses is an income statement account, you see that individually, revenues will increase our stockholders' equity because it goes on retained earnings. It increases retained earnings and increases equity. So even revenues, just think about it, if we increase our revenues, it's going to be through a credit, right? So all we have to do to journalize is to make sure that we can record it in the right way. This is the only thing we have to do when we think about journalizing. What we have is what you call a double entry system, double-sided entry system, which helps us to check to make sure our stuff is right. It's one thing to just add stuff, but how do I balance it? How do I make sure that I didn't take stuff out of the wrong thing? I can do things and mess them up. So if I can mess them up, I need to have a way to check, okay? We want to show our debits and credits. We know how it works by writing them, and we simply write them like this right here. If you debit something, I'm just going to use the word, and we'll come back in a second. If you debit something, if you're using a piece of paper, you always go well, I'll use this, let me come over here because we have like a paper right here, okay? You always want to put that closest to the left-hand side if you're debiting something, okay? Everybody good? If you credit something, all you're going to do is just indent over, and whatever account you credit is going to be right there. Does that make sense? So we, like I say, we really learned this the first day. Now we're just going to just hang some stuff on it. So if you debit something, you always write it, or as we see in our screens, there are blocks. You know, there's maybe a block here and a block here. The debits always go in the block that's closest to the left-hand side of your screen, okay? That's really it. If we're going to show an increase of cash, do we debit or credit? I debit it, right? So I know that it goes right here on the left-hand side. Okay. Everybody feel good so far still? If I credit it, that means that I've reduced my asset, or I've created some liability, or I have more ownership. Whatever you credit is always going to be indented. And whatever you have over here in the end, and I'm putting it like this because you can have, sometimes you can have more than one debit, okay? And you can have more than one credit. They can be opposite, but as long as you have the same, if you have the same there, then you know at the very least your numbers are right. Now, you may have kind of gotten off on an account, but like I said the other day, you might mix up supplies and inventory. Supplies are those things that we use to help to get the business going, but the inventory is what you actually sell to make the money. So you may get that off, but that's going to be okay. Okay, at the very, with time, like you're going to get that down pat. So does this system make sense to you? It's a double-sided entry system, and the whole deal is that we can check our work. Okay? So you ready to try some of these? There were some homework problems we had where you just simply identified such and such as an asset or something as a liability. And we did that in class last time, right? So if you can do that, then we're ready to keep on going. And now, we're going to start doing our first journal entries in here. Is this going to be anybody's first time doing them? It's going to be easy. Is this going to be your first time doing a journal entry? It's going to be really easy. Let's look and see what we have here. We have a business, and by the way, always think of these as the business. If you think of this as anything other than the business, your perspective is going to change, okay? So we're going to make sure that we always think of this as the business. So we have a business here, and I think that's a pretty good thing to do first is to get some supplies on hand, right? We're going to purchase some supplies. Now, reading these questions is not hard, but we just want to make sure we don't miss anything. Generally speaking, you can purchase things with cash, we agree. You can purchase them on credit. If you see something purchased and it says cash, simply means you purchased it with cash, okay? How do we know if it's on credit? Usually you're going to see something called on account. So if this has said purchase supplies on account, that means that I have debt, which means I've created a what? An asset, liability, or equity? A liability, that's right. So if it says on account, then we're simply talking about purchasing something that is, and we have a liability, okay? Other than that, we're going to say we purchased it with cash. That's going to be really the only thing that we have. Did you have a question there? Okay, all right. So everybody got that part so far? Yes, ma'am.
So like you were saying, anything they pay in cash is an asset, anything they pay with a credit or is a liability, but with the stockholder equity, is it just going to say common stock or retained earnings on there?
Yes, it's more so going to talk about the common stock. We have ownership, or we bought such and such amount of stock. Yeah, that's what it's going to stay there. You're not going to say we purchased or sold any type of retained earnings, because that's more something of a collector's item, if you want to call it, that we do over time. But you will purchase common stock. Think of what you're doing now. If you purchase stock, you're just purchasing some ownership in a business. It's like anything. If you open up a business, you have a separate bank account and you put some money in there. You've invested in yourself. You purchased 100% stock, even if it's only $3. Then you put $3 in there for your stock. Okay, so that's all that we're talking about when we purchase stock. I wish I had known that when I took it, because I didn't know what stock was. I mean, I really didn't know it all. So it's just ownership, and you think of it as investing in your business. Anybody want to open their own business? I would say start playing around with a business plan now. You know, it's you have this stuff, and the more you can make it personal to you, the better it's going to feel in terms of, you know, what you know. Okay. So let's get started. What's the first one say? The first one says what? Purchase supplies for $960 cash. Purchase supplies for $960 cash. Let's think about what we're doing. We're buying some supplies. Supplies is an asset, liability, or equity. And we're purchasing them with cash. Is cash an asset, liability, or equity? Asset. We agree, right? You gotta understand that if I wasn't teaching this class and sitting at a desk doing this, I still do the same thing, right? I'm just doing it a lot quicker. I know that supplies, asset, cash is the production of assets. I'm still saying the same thing, just a lot quicker. So as we learn it with each account, I just want us to get to the habit of saying whether it's an asset, liability, or equity. Even things like accumulated depreciation that we talked about. It is not an asset, but it falls under the asset category. So in your mind, think about it falls under the asset category, okay? This is going to help us as we get new accounts later on. If I say account is called, I'm just throwing out some syllables. If I tell you that's an asset, then you know you increase that account by doing what? Debit. It don't matter what it's called. You just write, I can't even say it again, I don't know what it was. You just write it down because you know it's an asset and increase it. So as long as you know it's an asset, as long as you know it's a liability or equity, that's what's going to help us to get around this class. So we purchase some assets with some assets. That makes sense, right? Let's think about it like this. We purchased some supplies, and I'm going to try to do this journal entry over here because it's only here. We purchased some supplies, and so when we purchase, we're adding supplies. So how do we show an addition of assets with a what? A debit or credit? Debit. So I'm going to purchase some supplies. I'm going to add some supplies with a debit. I increase my supplies with a debit. I pay for it with cash. If I pay for something with cash, have I increased my cash? I decrease my cash. How do I show a decrease in cash? With a debit or a credit? So how will I show the credit up here? Will I write it on this side over here, or will I indent a little bit? I'm going to indent because I'm showing that my cash is going down a little bit. Okay? The amount is $960. You do the same thing with your numbers. You indent one for your credit. And now, does that look like a journal entry to you? That's your first journal entry. I've shown an increase in my assets, which I paid for with my assets. Have I gained anything? Have I gained assets at all? Have I lost assets? Think about it for a second. I bought some supplies. Now I have these. So I gained assets, right? We agree. But I also paid for some. Well, I don't have any money on me today, but I just believe I paid for them. I didn't steal them, right? So believe I paid for them with cash. And that means that another asset went down, right? So does this thing balance? Even though I'm just on this side right here, does this balance? At the very least, I feel good. My numbers are right. It's just a matter this is a mistake. I'm gonna show you a common mistake. It's just a matter of if I accidentally said supplies expense. That is not the same. Remember, an expense is a using up of assets. Supplies is an asset. So if we're talking about purchasing supplies, don't accidentally pick supplies expense. That's totally different. But you see how you can have the little mistakes coming out? I would write that, put a star by, or maybe start you a thing where common mistakes. A common mistake would be mixing up supplies with supplies expenses, okay? That would be a mistake. And it's a common mistake. You'll make it at first, but just remember the asset is just simply supplies, okay? And then we use it up. Anything that we use up, we put expense behind it. So if we're not using it up, it's going to be an asset, okay? Now inventory, there's no such thing as inventory expense. It's called something else, which we'll talk about later on. But any increase in an asset is always going to be the asset itself. We're just going to put expense behind it if we're using it up. Nod your head if you're feeling good so far. Okay. All right, so that's good. We did the first one. Now, we're going to do something a little bit different. We're going to do this right here. We're going to thank some people for investing in our business, right? And how do we do that? By paying them a what? A dividend. So we're going to pay $350 of a cash dividend to some people. Let's think about it for a second. Let's go back. I mean, when you get lost, sometimes it may feel weird to go all the way back, but let's go back because it's going to help us. the first place we saw anything about paying dividends was in our statement of retained earnings, right? Now, this is not for a test, but let's just think about it. With retained earnings, we increase our retained earnings with a what? With a credit, right? And we decrease our retained earnings or stockholders' equity with a debit. So think about this now. I'm going to pay some dividends. Now, dividend is a type of expense, but it's not like these other expenses. A dividend is a reduction of retained earnings. A dividend is a reduction of retained earnings. One more time. Retained earnings. Do retained earnings increase or decrease equity? Do retained earnings increase or decrease equity? We agree, right? Retained earnings increase equity with the credit. Is everybody good on that part right there? Sound good? So anything we do to reduce retained earnings, we're going to do what? We're going to show it as a debit, right? Retained earnings are increased with the credit. So anytime we reduce retained earnings, we're going to do the opposite. That's to do what? Debit. Sound good? Okay. Now, we pay dividends out of income or retained earnings. Out of income or retained earnings. Out of retained earnings. So to have a decrease to pay dividends, we're going to debit it because it's going to show a decrease. So I'm going to just write this here right now. We'll come back to the journal entry in a second. We're going to pay dividends. Okay. But then we're going to pay dividends of what sort? We're going to pay some cash dividends. Now we're going to cross the equal sign. So if nothing else, if I did a debit over here, then in order to make this thing balance, I need to do a what? A credit. Now to get to the counting part, I know that if I'm paying cash, I'm going to show a reduction of assets with the what? A credit. So I'm going to pay cash. $350. All right. Everybody good so far? So inside, make sure everybody can see. Okay. Everybody still good? Now all I have to do is yes, ma'am.
So with the 350 cash dividend, it gets included in both asset and stock equity, but so far nothing's been included in liability like the supplies. Cash is cash. Cash dividend, that is, since it's a dividend, it does get included in the stock equity, but since it's cash, it gets included in asset.
That's exactly right. Two different categories. And so what you're doing is what we talked about a second ago. You said dividends, and you associated dividends with what?
Stock equity.
Stock equity. And then you associated cash with, so it's okay. First of all, when we had another one, the one we previously did, we only dealt with assets. Now we're dealing with something else. Yes, we have these assets, but now we're going to pay someone for investing in our company, give them a little bit of motivation to continue, right? So you can have different sides as long as when you finish, it balances, right? That's our key. So knowing that we have a dividend and dividend is debited, does it go all the way close, or do we indent it a little bit? I'll tell you, let's start with the cash. We're going to pay some cash, right? And we show a cash by a decrease in cash with a credit, right? So with that credit, do we decrease or increase credit? Let me just, I can write you a cheat sheet right here.
It would come more to the credit side.
It will go more to the credit side, that's right. I'm going to write this little cheat sheet, that way we know debits and credit. So it's going to, you said more to the indentation, right? So we're going to have a cash indented there, and we paid dividends. Dividends on which side? The debit. So that's going to go closest to the left, okay? Now it's not dividend expense. Sometimes they may do that, but it's not dividend expense because expenses are usually associated with things in the income statement. And how much was it for? $350? Does this right here balance? We know it balances here. We checked here. Make sure it balances, and then we just know that this is always associated. This is not going to be in your book, but this is just one of those things in terms of how we think. We know that this is associated with retained earnings, and this is associated with an asset and those balances. Okay? Everybody feel okay so far? We're journalizing. Yeah, yes, ma'am.
So are we like doing, like, is that specifically under liabilities?
No, ma'am, I just had to kind of
Okay.
put it somewhere.
Okay.
But watch this, let me help you out though. This, I tried to put it right here so we can see a little bit better, and then I wanted to put it over here on our assets. Unfortunately, we don't have any more space though. But does that help you out? What she wants to know was, does it fall in the liabilities? No, it doesn't fall in the liabilities. That's why I kind of put this around to make sure that we know it's its own thing. Okay. You feel comfortable with that there? Okay. Yes, ma'am.
So whenever we write it under the stock equity, the dividend, like it would be the dividend cash, but it would be directly under, like it would be dividend cash instead of cash being more to the side.
Oh, in terms of this versus this? Yes. The reason why is because can you see that back there? If it's not, I can try to write a little bit higher. Can you see this down here?
I can see it.
Okay. Anything that is debited always goes closer to the left. And then anything credited always comes out here with an indentation. Even if it's, like I say, we're used to seeing cash go up. If cash were going up, it would have been debited. And that's just for presentation, okay? Does that help you out?
You don't write anything for under stock equity then, it only just goes under asset?
Can you ask me a different way?
So the way that I wrote it is, I wrote dividend cash and the 350 the same way that the supplies cash is.
Okay, so you wrote,
But I put that under asset. But under stock equity, I have dividend and cash at the same level, but the 350 goes the opposite way versus that way. Is that way?
I think I can see what you're saying. You're saying under your stockholders' equity, you have, let me find a different color marker here. Okay, you saying under your stockholders' equity, you have,
I have dividend cash and it's directly under.
now, when you say dividend cash, what are we saying? You say dividend and cash here
Cash is on the left side.
is on the left side, like this right here?
I have it directly under dividend, but.
Okay, so you have it like directly under there. Okay, gotcha, okay.
And then there's the 350.
350 here, okay,
And then the 350 closer to the cash under.
this way. Okay, all right, gotcha. All right, so that's what you have, right? Let's see what it tells us, first of all. I think that's the biggest thing. Let's see what this tells us. Because even if you kind of mix this up, because this is, what you basically have here is that they're both at the same level, I think. They're both right up against the wall.
I just assumed it was the same thing because the
That's okay.
supplies ends at the same as the cash on the first one. They're both level at that end. But since we're doing the debit on the other one, I assumed it would match on the other end.
Let's see what it tells us. This here tells us that with cash, that we're gaining cash. You have a gain because your cash is debited. Anytime we debit cash, it's a gain. So what we have right here, the way this will look over here, this is saying we're paying cash because it's on the right-hand side. If we were making some cash, we would do what? Put it over there. That's what this is showing that you made cash because it's on the left, on the inside right here. Does that kind of help you out there?
So we're not making cash, so
You-
we wouldn't have it.
Right, and that, I think that kind of goes back to how we look at the book. Remember now, this is, let me just say this is our company, okay? This is our company, right? We good with that? So we are paying them over there some dividends. Since we're paying them dividends, then are we giving them some of our own money? So that's why this would be credited over here.
So nothing goes under stock equity yet.
Yes, dividends would still fall under stock equity. A dividend is an equity type of account. Let's go back to we have our income, minus expenses is going to give us our profit, right? And then we add that profit to our retained earnings, right? Plus profit, I'm just going to say that, plus profit is going to equal my ending retained earnings. And where does ending retained earnings go? It goes here, right? So all of these are equity type of accounts. Is that going to help out a little bit? Okay. Sure.
I'm just still a little bit confused, but I don't want to take up any more.
No, that's okay. As we keep going, the more we do, the more it's going to help. But does it? If it doesn't make sense now, do you see that at the very least, all of these are associated with equity? So anything that increases equity is going to be done through a what?
Increase
Through a credit.
of credit.
Okay. And dividends, we're paying them dividends, right? So is that increasing our equity? So that's why we have dividends on the left-hand side of stockholders' equity. Is that a little bit better there for you? Okay. But do we see that the question she's asking there? Because that's one of the weird ones. To me, that's one of the harder ones because dividend, we're not saying dividend expense. This is just talking about a simple payment. So we want to think. That's why I say think every time. What is it associated with? Is it increasing my asset, liabilities, or equity? Well, first of all, is it affecting my asset, liability, or equity? And then if it's increasing or decreasing, okay? Everybody good? We're gonna move to the next one? Let's see. Our next one is receive a down payment, $4,900 down payment from a customer for services to be provided in the future. I'm just going to get rid of this here. Now we're talking about something that's going to be provided in the future. We got the money in our hand, right? Is that true? Have we done anything yet? Have we done any service for them yet? So can we say that we earn that revenue? Can you walk out of here if I give you $500 and wash my car, like literally right now? Can you say you earned that? A thief can though, right? Because that's his job. But you can't say that you earned that until you go do what? Wash my car. Now, in the meantime, either you're going to wash my car or you're going to say, hey, look, I can't get to it. You're going to give it back. Remember we talked the other day about the basketball trade and they gave the money back because the fans were expecting a certain thing. So if you don't do anything yet, then you owe someone. And if you owe someone, that's called a what in terms of assets, liabilities, and equity? Which one is it? A liability, okay? All right, so we received $4,900 down payment from customers for services to be provided in the future. That down payment is usually done in what? Cash, right? So we receive cash. What do we do with our assets? This is our company, remember, not our personal, but our company. Did we increase our assets or did we decrease our assets by receiving cash? Even though it's not ours, it's in our hands, right? So is that an increase? So we agree it's an increase? We disagree it's an increase? I can't go on till I know what we think. Do we have an increase or a decrease?
An increase in the cash that's in your pocket.
That's in my pocket. Even though I haven't earned it yet, it's in my hand. I have to account for that. Literally account for that in this point in time because we're doing accounting. So I have to account for that. I have to put it somewhere under assets, liabilities, and equity. We already know that cash is a what? An asset, okay? And so how do I show my increase in assets? With a debit or credit? That means that this is going to go far to the left or indent? Far to the left. We're just going to call this far to the left here cash, okay? Now, I also have not done what I'm supposed to do yet. It's not that I did anything wrong. I just can't, we can't go get that car washed because we're in class, right? You're going to do it later, but right now, you owe me that. You either owe me the money back or you owe me the car wash. So until you do that, you have a what on your hands? An asset, liability, or debt, or equity? A liability. So that means we have an increase in liabilities. How do we show an increase in liabilities? With a credit, okay? So even though I'm over here, I wish there was another way to do this without having this up here, but this is the only way I can do it. So we're going to have unearned revenue that is credited. Don't think of this in terms of assets and liabilities and equity right now. I think it probably helps to erase this right here. Don't think of this in terms of that right now. Let's just think of this as just a journal entry, okay? So I have increased, well, let me ask you, what does this do? This showing I increased my assets or decreased my assets? Increase, right? This showing I increased or decreased my liability? Increase. By how much? 4,900. Everybody okay with that? Everybody good? Just take a second, see if you have any questions. Can I ask you something that's not in the book right now? It's going to be in the book later on, but can I ask you a question? I have a liability on hand. We have a liability on hand, right, as our company. We wash cars. Now, after class, we're going to go wash that car there, right? After you wash the car, will you still have a liability? No. If I increase my liability with a credit, how will I reduce my liability? With a debit, okay? This is not in the book. This is actually just thinking a little bit ahead, okay? So once I wash the car, or once we wash the car, then I reduce the unearned revenue. Okay, so I'm going to debit unearned revenue. And at that point in time, I will have earned the revenue, and revenue is an asset, liability, or equity type of account. Equity. How do I show an increase in equity? With a credit. So at that point in time, I will now credit, I'm just going to call it sales or service revenue. Revenue is the key word. We'll talk about sales and service later on, but I now have revenue. So at that time, I would have completed the service. That's later on in chapter 4. Okay, so this really is the kind of stuff chapter 4 talks about. I finished the job. Now I can do this. I use up such and such amount of supplies. Now I can record them. So this is not for this chapter. This is not this exam. But if you're starting to, if that made sense to you, then you're starting to be in pretty good shape for the exam. Okay, because this is later on. But any questions? First of all, any questions on that? Okay. All right. Ready to get back to the book. All right. But no questions on this. This is the main thing for our exam up there. So as long as you are thinking about that, then you are where you need to be. I'm gonna keep going, okay? Anybody tired? Why y'all? Oh, we had lunch, right? We did have lunch, right? Y'all had some good lunch. What time is lunch over with? There's no such thing, right? Man, you know we had to be finished eating lunch at 2:30. And then dinner opened at 5. So we had to, we didn't have all that stuff, man. That's messed up, man. That's messed up. And we still gained weight. So it no matter what they offered. All right, so next we're going to receive $710 cash. If we know nothing else, we know cash is a what? An asset. And we ain't showing an increase in assets with a what? With a debit. We know that, right? So we don't get half of this right. You get partial points. You get, like you said in your homework, you get partial points for this, okay? So we know we're going to get that part easily. We received $710 cash. Now, from a previously billed customer for payment of services provided in the prior month, okay? For payment of services provided in the prior month. We'll deal with that in a second. I forgot, I can let you see some of these things that you've already done here. This probably would have answered your question a little bit earlier. Excuse me. Does that help answer your question a little bit earlier, those answers there? I forgot I could show you the answers. We're just taking a pause just to make sure that what you thought you wrote is is right there. So did anybody write anything different?
What does it say on the credit?
Right there? This one right here?
All the credits are blank.
All the credit,
No,
that's that thing again. I know what that is. Thank you. Remember the day you told me that? All right. There you go. Does that help you out there?
Well, you just kind of did it.
Huh?
Like, on both sides.
Let's see, is this here or, oh, you're talking about over here? Is this what was throwing you off earlier?
It'll take me a good little while just looking at it myself to understand it.
And you'd be surprised, it probably won't take that long. It really won't take as long as you think, because I see that you're answering all the questions. I think it's more so developing a confidence, doing it by ourselves. So it's not really gonna take as long as you think, because we've been doing it, remember, pretty much since day one. It's just now just right a little bit different. I think I can see something that you were saying earlier. It looks like these are so close to each other. That may have been what was throwing you off. It does look pretty close, the way they did it there. It looks very close. Oh, I done cheated and showed y'all the next one, I'm sorry. Let me take that off. All right. So let's go ahead and keep going here. Remember now, we're receiving $710 cash from a previously billed customer. We're talking about a previously billed customer. We're talking about something that we sold to somebody, but we didn't receive anything in that time, okay? If we sold it to somebody and we didn't receive anything, we either going to receive cash, which we did not, or we're going to receive a promise to pay. That promise to pay is a current asset called what? Accounts receivable. So accounts receivables, we expect to receive money from everybody, right? If we had to pay someone, that would be called an accounts what? Payable. That's one of the two that kind of get mixed up a little bit. Remember, it's your business, it's our business. When we expect to receive, when we sell something, we expect to receive cash or a promise to get that cash later on. That's accounts receivable. So in this case, we previously had, right here where we say we previously billed, this is where we build them and they're going to pay for it. They may want to get something and try it on to see if it's going to work out right. They tried it on, we paid, they paid, they tried it on, they're going to keep it. So now we're going to receive $710 from that sale. Accounts receivable, we know what cash is. Accounts receivable, let's talk about accounts receivable. Is accounts receivable an asset, liability, or equity account? Asset. We agree? Okay. Do we increase assets with a debit or credit? When somebody gave us a promise to pay, we said that we're going to increase our assets because we could depend on them and count on them to do it, right? So once they paid us, are we still going to have that accounts receivable on the book for them? If let's switch around just a little bit. If you owe me, right? And once you pay me, don't you want me to take your name off my books, right? So now we have to take their name off the books. If we put their name on the books with a debit to accounts receivable, then we take it off with a what? With a credit. Sound good? So we receive cash, we agree on that, and we know we're going to debit the cash, right? And then we are now going to take their name off the book, and so we're going to reduce our assets by the same amount. Now I'm going to write assets for a purpose, once again, to just show us, or to remind us of what things equal, how things are equal, okay? So, we receive cash. And we also reduced what we were owed. This is accounts receivable. This is cash. Both of these are current or non-current liabilities. Current, that's correct. Both of these are current liabilities, okay? This is our journal entry. From here, how will I record this? say debit blank, credit blank. But you fill in the blank though, okay? Debit, cash. This is my imaginary end of my paper over here. Debit, cash, and credit. How do I show a credit? Say again? A slight indent, that's right. Accounts receivable. For 17. Thank you. 710. This here is my journal entry. I will go to the journal entry part first. And I say first, actually that's not the first thing, but I know we know what we have to do with it, but I want to make sure we understand what's going on. Have my assets changed? Has the total amount of my assets changed at any point in time yet? No. We already made the sale. The sale was made over here. Okay, so at the initial sale, just to kind of give you an idea of what went on, we actually credited revenues. Okay, the actual sale that happened at first, you can, this is just for us. Okay, when we initially set this up on day one, when they bought it, we normally would have a cash sale and some revenues, right? That's what we normally would have, right? A cash sale and some revenues. We agree? Revenues is equity, so we credit it to show the increase. We're good on that part, right? And we would have received cash, but we did not receive cash. We received a promise to pay, which is just changing the asset around to accounts receivable. Okay? So you see why we can say the asset increase. Either we're going to receive cash, or we're going to receive a promise to pay, or we could have received a little bit now and a little bit later. In that case, we would have still had cash, accounts receivable. But I promise you, it would have still, maybe, let's say we would receive maybe $500 cash and $210. We still would have had the same sale, right? Somebody just paid me a little bit now, they're going to pay me something later. This is totally different now. This is later on, but does it help us to appreciate that, number one, our assets did not change over here? And to appreciate what accounts receivable is, remember, we could have just had cash, but for some reason, they didn't have the cash, and they just wanted to pay us. They said they want to pay us later on, okay? Is that helpful to you? Especially in terms of this is coming up, chapter, that's revenues, let's say revenue, okay? That's coming up, this is coming up later on, but this is maybe to help us appreciate there. Do we feel comfortable with this right here now? Okay. Okay. Well, we're gonna let you try the last one on your own. How about that? All right. Try the last one on your own right fast. We're going to purchase. I'm not gonna let you do it. I kind of can't help it, so I'm gonna have to keep on going. But I'm gonna try to let you do it on your own. Okay? You're gonna. Remember, this is us. We're talking about the company now. Our company is going to purchase some equipment. Think in my head, what? Asset, liability, equity. Asset, okay? Purchase equipment this much by paying how much for cash? What's in my head right now? Asset, liability, equity. And issuing a liability for later on. Understand that is the opposite of that, okay? This is something totally different here, but it's the same concept. So use the same concept and think now. We're buying some equipment. We're going to pay some now and pay some later. Remember, over here, we sold this to the customer. Now we're buying something. So I'm going to erase it so we don't get confused, but this is the same concept in reverse that we just did, okay? We purchased an asset. We paid a little bit of cash now, and we're going to pay some more later on. Okay. We want to erase this as well. We'll have this down pat by the weekend, right? Okay. Yes, we will. Yes, we will. We will. It's just Monday. We get a long time, right? Y'all don't have any exams this week, right? You have any next week?
Your exam's the first one I gotta take.
The first one?
Yeah.
Is that good or bad?
I have like, I think your exam's next week, and then the week after that, I have history. But I do have a final stat, like wire statue I have to have submitted tomorrow.
But now the good thing is you have 3 days to take mine, right? So you can, if you have to take it on Monday, fine. If you need to take it on that Wednesday, just please make sure you know the testing center hours so that we can get it. So good thing is that we don't have to worry about that it has to be Monday. I hope it doesn't have to be Monday, unless we want to get it out of the way, which either one is fine, okay?
I'll come talk to you on Monday, that's fine.
Hey, that sounds good. As long as you get it, right? As long as you get it. That's what I'm here for. All right. Everybody ready? We ready to try to put it on the board? All right. Just go when we see something. And obviously on the exam, we're not going to see anything we never saw before, right? But as we get to new chapters, we're going to start seeing new accounts. Whenever you see a new account, your first thought is whether it falls under asset, liability, or equity. So we're going to generalize, but we're just going to walk through what we think at first. We're going to purchase equipment. Equipment is a what? Asset. Does it go on this side or that side? For the purchase. Debit, because we are increasing the equipment. We agree? All right. We're going to pay for it with cash, or we're going to pay for it on credit, or both. Both, right? So we're going to now deal with cash. Cash is a what? An asset. So should I use this one? I'm going to use this one. I don't want to confuse you with something I'm doing over there. We're going to show a decrease. Yes, it's really kind of gloomy when you have to decrease, so we'll use this marker here. We'll decrease our cash. We agree with that, right? So, I'll come back. I'm jumping a little bit ahead. What about that liability? Accounts payable. Okay. Debit or credit? Credit, because we are increasing the liability. So are we good with those categories first? Okay. This is going to drive home one more point. The word debit or credit has no meaning of whether you increase or decrease. It simply means left or right. Okay, so that kind of just reinforces that concept. That's why I say it's just the left side. The left side. In this case, it's not even affected. Okay. Now remember, we always talk about things must equal. So, how much was the equipment? $2,400. How much did we pay out in cash? $800. Was it $800 you said? $800. Now, notice that in accounting when we subtract something, we kind of put it in parentheses, okay? So, $800. And we owe how much? $1,600. It goes over here, right? $1,600. So, at the end of all of this, at the very least, I have my net assets, I have this, and I brought this much in terms of equipment. This went out, so I have a net balance of how much? 2,400 minus 800, or 24 minus 8 is what? 1,600, right? And how much do I owe? 1,600. At the very least, do I balance? Okay. Now it's just a matter that I put in the right account. Okay. You're probably not going to mess these probably up, but if it was accounts payable, accounts receivable, that's an easy one to mess up. So just kind of be aware of that. Okay. This is what I have here. Now, I notice a difference, but my whole balance increases. So this equal sign, once again, the double-sided interest system, it balances. We're good to go. Now it's just a matter of writing it on my paper, right? That's my paper. What do I debit? You can just take it from here. Your equipment. Equipment for $2,400. What do I credit? Cash. Cash, because I put a little bit on it, right? That's my credit over here. And I have a liability. It's shown as a what? A credit. For 1,600. Let me check my work, make sure I'm okay. I have 2,400 over here. I have 2,400. I might not be totally right, but my numbers are right, okay? I might have messed up. I mean, I'm just saying where I could possibly go wrong making mistakes. I could, if these are correct, I probably just messed up and put the wrong count in there, okay? And that's it. You have now journalized today. As usual, you want to know this one, right? I did this one in class, right? So please know this one for your exam. Know them all, but know this one. If you get a chance to, if you haven't started chapter 3, I would just say practice those with the drop down menus first. If you don't do anything else before you come in here, practice the drop down menus because you want to just say increase or asset increase and know which ones go there. Liabilities. That's going to help you. So if you want to go practice, great. Please go try this again. You have different numbers. If you don't do anything else, at the very least, please go and do those drop down ones, asset, liability, equity, to just get used to where these accounts go. If you have started, just make sure that you start saying out equipment, asset, even if it's like I say, accumulated depreciation, asset. It's not an asset, but it falls under the asset, okay? And start reminding yourself that all of this balances. Everybody good? Go Bills. Wrong team, I'm sorry.